Hello, good morning from New York and a good afternoon from Brussels. My name is Bart van Ark and I'm Chief Economist at the Conference Board, and I would like to welcome you to our monthly Window On series, which is a monthly panel on real-time economic and policy issues that are on our minds. And again, today we have a great program which is going to focus on political risk. Actually, on November 13th, the Conference Board will release its annual Global Economic Outlook, with estimates for economic performance around the world in 2019 and beyond. And no doubt there is a lot of uncertainty around the outlook for 2019 and beyond. And a lot of that is related to the fact that there is a sentiment that there is an increased risk in the global economic and political environment. Whether that perception is correct or not is something that we actually will discuss today. We have a great panel to talk about these kind of issues. And for that, I'd like to show you the topics that we're going to talk about today. We're of course going to start with discussing what are the biggest sources of political risk for businesses. And we'll start this webcast actually with a series of poll questions, so be ready for that, because we're going to ask you 3 poll questions very early on in this webcast that will give us some input for the discussion during the next hour. After that, we're going to go a step further and really talk about how do companies actually get affected by political risk. What are the channels for which companies are absorbing that political risk, being affected by it? How is it impacting your operations? How is it impacting more your long-term strategy? And then the third topic we're going to talk about is how do businesses actually mitigate or cope with that risk? And how can you prepare for risk that you don't quite know where it is coming from? And again, we will be able to speak to this topic with our panel. We're going to hugely benefit today from a report that was written by Oxford Analytica called How Are Leading Companies Managing Today's Political Risk? And that report has been written, or the lead author of this report is Simon Coode, and Simon Coode is Senior Advisor, Deputy Director of Advisory at Oxford Analytica. And Simon, we're very happy to have you here and hear about your insights from this report.
Well, no, thank you for the opportunity to join you.
Great to have you here. And then we're going to join also by Harry Brodman. Harry Brodman is a good friend of the Conference Board. We've done multiple things with him over the years, all related to the issues of political risk and so on. He's a former senior managing director of the managing consulting practice of PwC on all emerging markets, and also the chief economist there. So Harry, you have a lot of insights around what is going on in different parts of the world. So we're very grateful to you for joining us today here. Great.
Thank you, Bart.
And then I have 2 of my colleagues who are regular attendants on this panel here. First of all, in our Brussels studio, we have Ilaria Mazzelli, our senior economist for Europe, who will give us the political risk insights from the European perspective. Hi, Ilaria.
Hello, everyone. Thank you for having me again.
And then right in the middle here in our New York studio is Brian Shaitkin, just back from China, so he can also talk a little bit about China political risk because he just studied it last week, but surely also going to talk about the perspectives from our US companies and our US member companies. Welcome, Brian.
Thanks for the opportunity, Bart.
Very good. Okay, I have to do 1 or 2 things. First of all, a few tips for you how you can participate in this webcast. It's actually appearing on your screen. Most importantly, we'd like you to ask questions because we can put those questions to the panel. Please ask those questions anytime. Don't wait for the Q&A time. If you have questions or you hear something you'd like to follow up with, just put it into the chat box there and we'll pick them up during the webcast. We have a couple of points during the webcast that I can deal with those questions, so please do so. Also, there are some other things that you can maximize the utilization of this webcast. But also I'd like to mention to you that there's a brief evaluation at the end because we always like to hear from you on how we can do better. And then very importantly, you can download the program on demand shortly after this webcast. So if you have other colleagues who would like to see this, please do so. And next week we will release a podcast where we're actually going to include some of the highlights from today's discussion for those of you who have a limited amount of time but would like to listen for about 20 minutes or so to the most important insights. So that's all for introduction. So let's go to the meat. And as I said, we go and let you work as an audience right away. And for that, we're going to go to the first poll question, which should be coming onto the screen now. And that's a very simple poll question. We'd just like to hear from you what you think about political risk for 2019. Do you think it will intensify? Do you think it will stay about the same, or do you think that political risk in 2019 will actually decline? And we'll leave it open a little more so that we can see more responses coming in. And then I'm going to ask each of our panel members very briefly for 30 seconds to sort of give their first impression. So we're going to close the poll right now. Perfect. So we have about 55% who are saying we think it's going to intensify, about 40% are saying we think it's going to be about the same, and about 5% is saying it's going to decline over time. So Simon, let's start with you. You've studied this very closely over the past couple of months. Is this a surprising outcome? Is this what you hear?
I think it's very consistent with both what we found in the survey and what we hear from our clients, that we're, number one, we're in a period of intensified or elevated political risk, and that broadly speaking, there's an expectation that it will impact more industries and countries as we move forward.
Yeah. Brian?
I think there's definitely a sense that multilateral approaches, and not just on trade, are drawing less interest. There's greater polarization in countries, and this is a concern that I've heard expressed in both the US and China. And that's going to lead to a situation which, as Simon's reports illustrates, that creates a less uniform and stable environment for businesses to operate in. And that's a major, major issue for businesses.
Yeah. Ilaria, what do you think of those results?
It's because I replied that it's going to decline, and I don't know if it is wishful thinking, but my reasoning was that political risk has been very high in the last couple of years. Economic policy uncertainty index shows that, so I'm not expecting that to continue increasing further because the levels it touched was really high.
And Harry, finally, what's your first response to those results? Surprised?
Yeah, to me, they make a lot of sense. I think what's happening is a diffusion and a proliferation of political risk, a contagion, if you will, around the world.
Good. So Harry, now that we're with you, we typically don't make these webcasts very theoretical or anything like that. But I think when we talk about political risk, I always think about what exactly is it, and because we talk about economic risk, we talk about policy risk. Are these things exactly the same, or are they different? So what do you think is specific about political risk, and how should we distinguish it from other risks?
So I'll give you my experience on the ground doing this kind of work with businesses for too many years. I would distinguish between three types of ingredients of political risk. One is where there's a new regime in town, either because of an election or because of a coup d'etat. There's a change in leadership at the pure political level. The second strand is that there's upheaval within the socioeconomic fabric, at the worst, violence, and other kinds of civil strife and possibly military and war conflict. The third strand, I think, is probably what's on a lot of people's minds, particularly in this country, but also in many emerging markets, and that is the economic policy or economic regulatory risk. And that could be either a change in the policy regime, let's say there's an increase in taxes, or a different regulatory regime, there's a new regulation about licensing of new businesses. But there is also policy risk in the sense that leadership is making policy in ways that are quite stochastic or random. And I would say, or interventionist, even if it's sort of not necessarily regular, whether it's the tax inspector coming to the plant and hassling the boss, or in this country, I think one of the more celebrated examples is the president talking about the Federal Reserve's policy and now naming the chairman about his actions. That's a political risk. That's a policy risk in our own country that is really, you got to go back a couple of decades before you have seen that kind of intervention.
And of those four, would you say that companies are impacted pretty much equally across those four, or is there one or two out of the four which are by far the most important in the way that companies in practice get impacted?
Well, I would distinguish the impact between sort of short run and long run, regardless of lines of business. if there's a change in policy, that could actually create a different decision-making calculus on the part of a country about how much to invest, where to invest, and so forth. Where there's political strife and upheaval, it's a question of, is the assessment that this is a short-run issue or a long-run issue, and it may not affect an investment decision or a purchasing or sales decision because people believe that it's going to pass. Or if it's going to stay, then it will affect those kinds of decisions.
Okay, well, we'll take this a little further in depth when we talk about this later on in the webcast on how companies are actually being impacted. But thank you for sort of giving us some clarity around these various categories of political risk. Now, before we go and dive a little deeper, we're going to ask two more questions to you, two more poll questions. So the first one is a geographical question. It is about, compared to 2018, in what region of the world do you see political risk increase most in 2019? There are different regions in the world, and you can think of the different risks that you're thinking about. Where do you see the largest risks actually occurring over the next year or so? And we'll give it another, it's a long list, so we'll give it a few more seconds for people to get their arms around this. 5, 4, 3, 2, 1. Okay, good. So the majority, more than 1/3, Middle East, and then actually that's really the large chunk. And then the second is Asia Pacific. A lot of that may be related to sort of China issues and North Korea, of course, and things like that. And then another high one actually is Europe, which is quite interesting. I'm sure Simon will talk about that a little later. Why is Europe so high right now? And then the rest of the votes are divided across North America, Russia, and Africa. So that's geographically. So let's keep that in mind. Middle East, Asia Pacific, Europe, and then the rest. Now we go to the second poll question. And that is, what most important geopolitical threats is of greatest concern to your organization? And there's a list here. Of course, this list could be endlessly long. I just borrowed here from the Oxford Analytica study here, so that it's easier for Simon to relate to. But there's an other category. If there's nothing there that you feel is the most important issue to deal with, then feel free to put it in the other. Also, feel free then to put it in the chat box what that other risk is, so that we can put that to the discussion. And again, we let you work through the list a little more because it's a long list and there may be things that you need to think a little bit about it. So let's give it 5 more seconds. 5, 4, 3, 2, 1. Okay. All right. Here there is again a clear concentration, and I think Harry already alluded to that a little earlier when he talked about policy issues. So protectionism and trade wars does get more than 50% of the votes, almost 60% of the votes. And then actually it takes a long time before we get to second place. It's this populism and nationalism, and then the rest of the votes are divided a little bit across various areas. So this is great insight and a good starting point. Let me start by asking my two conference board colleagues, and I'm gonna ask Ilaria first. From a European perspective, are these results in line, and more specifically, what kind of risks do the members in Europe talk about today?
Very much in line, Bart. And so let me start from the first question. I'm not surprised that Europe comes third in the list of geographies that are concerning. Actually, it might have come even second, because what is interesting that is happening right now is that in Europe, we are used to thinking that political risk is something that concerns emerging markets, something far away, Latin America, Middle East. But what happened in the last months is that we have seen political risk coming closer and closer to us. I'm thinking about Brexit, I'm thinking about Turkey, I'm thinking about this roller coaster of elections that we had last year, and where extremist parties became more and more visible and got more and more votes. So I think the selection of the audience reflects this concern that political risk is getting closer. Now, when we discuss with our members, there are two things that I notice in terms of topics. One, of course, reflects the short-term policy discussion, and this is why protectionism and trade war is something that's been in very high demand in briefings, in council discussions, and I had extremely interesting conversations around that with people trying to understand what's going on and how it can impact them. Now there, the challenge is to filter, I would say, the noise of the daily information, and really try to understand how it matters. And that's not easy at all, because sometimes, when you have too many information, it's difficult to make an assessment, because you're bombarded with information from all sides. So that's one topic that comes very high on the list here in Europe. And then the other topic, and maybe you will be surprised by that, is populism and nationalism, but in relation to inequality. So ever since I started working at the conference board, I think the question that I get in nearly every meeting I join is, how can this affect us? So there is an understanding that certain economic trends, increasing inequality, has somehow led to the increasing success of extremist parties. And companies are actually way more concerned than people think about this. They want to understand what is the impact, what can be the solutions, and this is something where research, included ourselves, have not been able yet to provide good answers. And I think that's, given that this is a very prominent topic, we should make an effort and try to understand how this can impact business, the society, and the economy.
Well, in particular, so how businesses have to respond to those kind of trends. And one concern is the disruption, but the other one is, how do you mitigate some of these effects, and how can you respond to it, if possible, even in a more positive way. So I think it's a really good point that you're bringing up here. Brian, going to the U.S., not surprisingly, protectionism and trade wars coming very high on the list. That is probably the largest political risk that our U.S. companies are concerned about, right?
That is absolutely true. There's a lot of concern right now about supply chain risk for U.S. companies, how that's going to be impacted. But I think it's telling that the area where there was the most concern about risk was not in the U.S., but instead was in Asia Pacific. And that correlates closely with what I heard during my recent trip to Beijing, which is that there is a lot of concern right now about how the trade war, or the current trade conflict, is influencing growth patterns in China, is reducing the level of growth, and how reduced levels of growth would impact economic and political stability. So I think there's a sense that a lot of the issues around the U.S.-China trade conflict are fundamental and can't easily be resolved as simply a negotiation over tariffs. They reflect concerns about intellectual property,
Right.
concerns
A
about
much bigger concern,
business
probably.
operations.
Yeah.
And so as a result of that fact, there's a sense that this may be a long-lasting problem, and that's a major concern for businesses, and that's why Asia Pacific ranks so highly.
Yeah, I thought it was interesting. You mentioned the word trade war, and then you quickly moved away from it. But frankly, we've heard now discussion about the tech Cold War, right? So it goes way beyond the trade issues. It's now really about who's the technology leader, and those are huge risks about if two superpowers are sort of getting at each other from that perspective. Who is going to be the leader in terms of economic power and technology power? That's a whole different game than just the trade issues that we're talking about.
Absolutely. These are issues that will shape how major industries, how competition in major industries will be governed over the next 10, 15 years. Certainly this is a very important issue and consideration in China, and we'll see how this plays out in negotiations in the coming months.
Okay. All right, Simon, let's go to the report. And just I should be clear, this is a report that Oxford Analytica produced together with Willis Towers Watson.
Yes.
The report is called How Are Leading Companies Managing Today's Political Risks? Downloadable from the Oxford Analytica website. Give us a 1 minute, 1.5 minute about, how was the study done? You did a survey. What kind of companies did you survey before we dive a little bit in your results?
Sure. So this is the second year of the survey. Last year was very much about understanding amongst corporates, is political risk affecting them? How is it affecting them? How are they managing it? This year was very focused on understanding how big the problem is and what they're doing about it. So in this case, we interviewed and surveyed about 40 very large corporates. they're broadly they're across a broad set of industries and sectors. What they have in common is that they're all global and they all have major global asset bases. And we were speaking primarily to risk managers, so enterprise risk management or country risks, as well as senior management.
Do you think this is a representative study of the business sector in general? Is it biased but is it focused on larger companies or particular parts of the world?
It's certainly more focused on larger companies, but those are typically the ones that are by default of being large more exposed to political risk, both because they make easier targets, but also because they have assets in all different places of the world. Our view is that while it's a relatively small sample, these are major global companies, all listed on stock exchanges. They have professional management teams. So by and large, we think this is a good measure of how companies are dealing with it.
So we picked 2 slides of your study, which not surprisingly show exactly the same classification as what we used in the poll questions. That was not an accident. Let's take a dive in this differentiation between different regions, right? And we saw earlier that respondents were saying, I think Middle East, Europe were the ones where we saw a rapid increase in political risk. Is that also what you saw in your study?
It is, and it gets to this point that risk is spreading. It's particularly for Western-based companies that have primarily grown up managing to economic risk. They're now finding that on their doorstep they're managing to political risk. So North America and Europe being very good examples of those, but also the number of sectors that are exposed to political risk has broadened. Just to sort of answer the question, what is relevant to political risk for corporates? The way we were thinking about this was very much through a lens of risk to expropriation, exchange transfer risk, import-export embargo, that would have a material impact on either revenue or assets. So we identified just now in the poll the point of protectionism and trade war. An example of a risk for a corporate through the trade war is some kind of local content requirement that would impact costs, as well as an import-export embargo that might be in place. From when you're looking at populism and protectionism, this is things that could impact through political violence. So isolated incidences that might close a mine, for example, through a worker strike, or the way a company messages key stakeholders, including customers.
What I find interesting here is that actually when you look at political risk increasing dramatically, the 2 things that really pop out here, I think, Middle East, of course, but certainly North America and Russia. So can you talk a little bit to that? Why specifically those 2? I guess North America has a lot to do with the trade conflicts.
So I think it's trade, but also for the first time in a long time, there's a lack of transparency about U.S. priorities and policy. So that essentially adds to complexity to management. Should a company locate in the U.S. or in a particular state? In Russia, it's again in part driven by what's gone on as a result of sort of its approach to interfering in elections, and the consequences that might entail.
The other chart that we picked from your study is quite interesting because it basically pulls the second poll question we did, sort of the major risks, and then organized them by impact across different kind of regions. Can you quickly take us through the most important insight here?
Yeah. So we see creeping expropriation as probably the biggest one to watch. So creeping expropriation in this case we think is going to relate to some form of resource nationalism. So this will lead to changes for a mining company, changes in agreed approaches to to mining in a particular place. There's also a growing inconsistency in big emerging markets between what the priorities are at the government level and what they are at the local level. That for countries such as Vietnam and Colombia has introduced some real problems. Emerging market crisis is very much focused on Africa, sub-Saharan Africa in particular, and US sanctions policy particularly relates to Russia and Iran.
I was surprised to see the creeping expropriation actually in the Asia-Pacific bucket, right? You would think more that might be, Latin America, for example, Venezuela, and those kind of places.
You would, and to some degree, it's one of these things that's flown under the radar because there've only been isolated incidences of this. But we spoke to a number of oil and gas and also mining companies that had been heavily impacted in Vietnam and Indonesia by changes of regulation.
Harry, let me go to you. You've seen the study. You've heard Simon talk about this. Can you just your reflections on this? What would you emphasize as surprising, interesting, or perhaps missing to the discussion that you would want to add here?
Well, I think it's covered very well. I'd say I would punctuate the findings and this discussion with sort of three regions. The clear gorilla in the room is China, and I would argue, going against, I think, conventional wisdom, that the growth slowdown that is occurring in China has been underway for many years, and it's not simply the result of the trade issue. And one of the things to keep an eye on is how the leadership who wants to continue to support state-owned enterprises will use the slowdown that otherwise was occurring and point to trade as the reason why this is occurring. And so I think it's important to distinguish between correlation and causation in terms of China. I am not surprised that Asia Pacific and the polling was the top, and I think that's exactly why, but I would underline caution there. I think the second area that's also important is North America. I think what has just occurred with the renegotiation of NAFTA, where frankly there's been very little substantive change, but there's an injection of a poison pill within this agreement to be shopped around by the USTR and the president on a bilateral basis with other countries. I think that frankly caused a lot of concern, and the treatment with our two closest neighbors, I think, gave a lot of people heartburn. So I would think that for that reason, North America is a problem. And I also think, as Simon alluded to diplomatically, that there's a lack of transparency in policy making. I would say that there's also a random nature, for the first time, at least in my lifetime, in economic policy making in this country, and that has, I think, tremendous spillover effects. And then the third area, I think, is Europe. And I think that while I had predicted a year and a half ago that Brexit may run into problems, but it was probably going to go relatively smoothly, I discounted the fact that there weren't trade negotiators left in Britain. I think what we're headed to now in the EU is really a bigger mess than I think anyone had predicted. And it's not obvious with looking at the roadmap ahead how it's going to clarify itself. And as we all know, business hates nothing more than uncertainty. And so we've got three big poles, geographic poles, North America, Asia, and Europe, where there's tremendous policy uncertainty in the short run. It's not.
Yeah, and I think that's a very important point I want to underline, because that's exactly what I hear businesses saying. They say, look, you can have these changes, we can deal with them, but it's the uncertainty that makes us, do we wait or do we move? And when it comes to the trade conflicts, for example, the question is, are you going to move your sourcing at this point in time? Well, if it is just on sort of, materials and so on, and you can find a good supplier somewhere else, that's doable. But if it is major investments that you have in one country and go somewhere else, it's a big decision. And as long as you don't know where it's going to go, you're going to stay put, and you run the risk of being hit very hard. So I think that's a really important point. There is a question, Brian, because you've been to China now. I was in China also last week, so I can share the question with you. But the question is, what will the impact of the trade conflict be on China's internal economic performance versus its export economy? Do you have any response to that?
So I think from an internal perspective, there is some concern about the ability to acquire components, and also thinking about over a longer term period what the impact of the present conflict is going to be on the ability to access technology. But I think overall Harry's point is well taken, that the slowdown in Chinese growth has been going on for a long time. It is the product of many factors, and to attribute it solely to the trade conflict would be inaccurate. But on the other hand, it's clearly the presence of the trade conflict and its possible long-lasting duration, I think, is causing Chinese leadership to rethink about how urgent change is in the present situation and what could be the possible impacts of any slowdown on growth on political instability.
Yeah, and I share that view very much. I was in China last week, and of course there's this ongoing slowdown. It is true, though, that the current trade disputes in the eyes of many of the Chinese partners I talk to is beginning to add an additional downward impact on the economy. So there's greater concern about a faster slowing of the economy than what would have been expected otherwise. So there's a certain amount of nervousness. But the thing that I want to say that I think is particularly concerning in this trade conflict is that both parties apparently don't hear each other. And by that I mean that the U.S. negotiation partners are saying, well, China will lead so much economic pain that they will ultimately give in. Well, the other thing I heard in China is that they're saying, yes, we will have pain, but we will not give in. That's not what we typically do. At the same time, on the China side, there is a sort of feeling that the current political environment that we're facing in the United States is very temporary and will go away. And again, that is an assumption that one cannot really take for granted. So I think that's another issue for business. If you feel that your policy leaders are not really listening very well on what is happening on the other side of the story, that I think is another concern. Let me move on. Let's go to the second section. Simon, how do companies' operations and investment strategy get affected by political risk? It's really important to begin to see what are the channels for which companies get impacted. So how do sort of the losses from political risk emerge for companies? Can you explain that a little?
Yeah. So so essentially, political risk is complexity. So there's an immediate impact on the cost side. Complexity might be things like you're operating in a country that is high risk from a security point of view. So you require additional costs to ensure that a product gets from A to B. That a bank can remain open during political protests. Then there are two other areas. One is retained earnings. So you have operations, for example, in Argentina. Can you actually get the money out and back to head office? And what is the impact of an exchange rate crisis on those retained earnings? And secondly, from a top line point of view, are you being prevented from meeting demand or charging the customer what you think they would be willing to pay? So there might be price controls placed on a business. There might be an import-export embargo for a mining company, for example. So those are a few of the common areas.
Right. So you find that 35% of all companies you surveyed have actually are seeing these political losses, and when you take the $1 billion plus companies, so the larger companies, actually 55% of them are saying that they're suffering these kind of losses. So where exactly did you observe these largest losses? How did they emerge?
So if you look at slide 7, the way we're reporting this is in terms of number of mentions of the people that we spoke to. If you look at two other data points, one is the actual amount that they reported, and also the Bern Union data, which is where political risk losses were reported. It's in the fairly obvious places, the high-risk countries here, so Russia, Iran, Iraq, Venezuela. But then if you take a broader look, there are also isolated but very material impacts in places like China, So this is when this is somewhat of a grey area in terms of how you value this, but impacts on trademarks and intellectual property, as well as the seeming arbitrary nature of the way government enforces regulation between domestic and foreign companies. And then just back to this point of the local versus government. There are a lot of places like India, Colombia, and Vietnam where a difference between expectations at the local level and the government level led to examples of expropriation or changes to agreements.
So what I find interesting about this chart actually is that Europe, which we addressed a little earlier, doesn't really pop up here. Was there a reason for that, or?
It doesn't, and that's essentially because by and large, from a corporate political risk perspective, the euro has remained stable. So there's been no major exposure to transfer risk. There've been no examples of expropriation risk. We think that's one to watch, where you may see, particularly going back to this point of creeping expropriation, examples like that emerging in the future. But for now, it's not been impacted.
It sounds to me that if you look at these different risks, that so that on the one hand there are these kind of short-term risks, like we talked about Brexit and so on. But companies don't. They see risks in terms of having to think about where we're going to locate ourselves or where we're going to do business. But they don't see these kind of bigger risks that you're describing here, like expropriation and things like that. So it seems again it goes back to Harry's earlier classification. Mm-hmm. There are these shorter-term policy issues we're concerned about that may impact revenue and things like that, and we have to mitigate it. And the really big topics that you were talking about here, like expropriation and other.
Yeah, and I think so. That's an important point, because essentially the bits that we're covering are the bits that the people we spoke to are willing to talk about. So these are sorts of losses that are in the public domain. But when you think about political risk from a complexity point of view, so managing to Brexit, managing in Italy, etc., those are the sorts of things that you wouldn't potentially report externally, but have almost certainly led to increased operating costs.
Ilaria, any thoughts on that, sort of Europe's risks versus those risks in other parts of the world?
Well, we have a few lessons that we can learn from Brexit, and I think there's been, I would say, 3 sets of concern in relation to that. And one, I think it's totally underestimated, so I'll start from that, which is the human capital related risk. So when Brexit happened, I remember we had this Ask TCD task force, and most of the questions we got from members were related to staff. So how can I make sure that people can stay, that what do I have to do, there was a lot of uncertainty around this. There is less uncertainty now, although it's not 100% clear, I would say. So that's one thing, that's the human capital risk. And then the other thing is, of course, the supply chains, but that's perhaps the most intuitive and obvious of the risks. And then there is a third set, which concerns the place as a market, as simple as that. So will I be able to sell? Will my sales go down? How will they be effective? The exchange rate related to that. So I think these are the 3 categories that I learned from Brexit to analyze this type of risk.
Yeah, to me, the issue of the dispersion of political risk in the report and in reality, to me, confirms what many of us who are trade and investment economists know, but there are some people, particularly in this White House, who don't understand that the world is actually multilateral and multinational in terms of supply chains. And I think, I hope the White House sees this report and sees this webcast, because I think it shows the disconnect between negotiating on a bilateral basis when the world is actually functioning and businesses are functioning on a multinational basis. Say what you will about WTO, and I was one of the trade negotiators in the White House at that time creating the organization, and I am a multilateralist at heart. But there's a good reason why the organization and why trade is multilateral, because firms are, as we know now very well, globalized. And so the dispersion and the diffusion of where political risk is popping up, I think, is consistent with that story. And I think it does beg the question about how far one can get in negotiating deals on a bilateral basis. It may well be good when you're negotiating real estate deals in a particular city, but it's a very different matter when you're negotiating transactions, whether they're trade, import, export, or investment globally. And so I think this is a really important point coming out of this study.
Yeah, so you know, as an economist, I of course cannot agree more with you than arguing that multilateral deals are the best way to get a win-win situation. But let me play the advocate of the devil a little bit here and basically say, well, I think one reason why the administration is arguing that we should go for bilateral deals is that they didn't get a good deal out of the multilateral deals. That they, you know, were taken on a ride, as the president is saying, and all those kind of things. But I think there's a certain amount of conviction within, convincement within the administration that these bilateral deals will give better outcomes for the United States. And even though that may increase the regulatory cost, because you're quite right, it's very hard for companies to navigate this noodle soup of bilateral deals, overall the result for the United States might still be better. What would you say to that argument?
So let's take two real examples: the renegotiation of the U.S.-Korea FTA and the renegotiation of NAFTA, which was done, as you know, in two parts, each bilateral to weave together a trilateral. And so the question is, what's the delta? What's the extra deal punch that this administration got by renegotiating these deals under the sort of the new bilateral umbrella that we can get bigger bang for buck? I don't see it. And I've studied both agreements very carefully. I've written several Forbes columns on them. I just don't see the big delta there. You know, I think the question is, you know, those are existing agreements, and there's the perfecting, in quotes, of those agreements. That's a very different matter from, let's say, at the very extreme of throwing out the window WTO and shopping around this existing NAFTA 2.0 agreement bilaterally to take place of a multilateral or plurilateral agreements. I'm not saying this from a theological ground. I'm saying this from I know how businesses are operating on the world, because many have been my clients, and I just don't see how the resistance, if you will, not on the part of business but market forces, to try to put into a bilateral battle something that is inherently multilateral and multinational. I don't know how you're going to get a better deal out of that.
Simon, any thoughts to that?
No.
Okay, let's go to it's a very well made point, Harry. So thank you for making the point so clearly. I want to show this slide to Simon. What types of political risk events cause the losses? What I was surprised about actually to see those exchange transfers losses so high. You know, you would have thought that most multinational companies actually have set themselves up for hedging and all those kind of things for some of those risks, but nevertheless it still comes up very high. What is the reason for that?
I think it's number one. Actually, not that many. Not all companies do set themselves up with hedging, or have a hedge in place that actually turns out to impact them on the downside.
On the right.
But the other thing is there have been the number of political risk events recently that have led to extreme collapses in exchange rates have just taken people by surprise.
Yeah.
So Mexico, for example.
Yes. Yeah, and with the rising interest rates, of course, some of these currency risks may actually become much more important going into 2019. So, okay, we have to go to the final section. Time flies, and we really want to talk a little bit about how do companies now actually sort of mitigate these kind of risks, and is there a plan for response? So, again, there's one slide in your study that really I'd like you to talk through a little bit, because it seems to me there are multiple ways of responding to those risks, but companies are really utilizing them to different degrees.
Yeah. So I think the first two that you see here are essentially about avoiding investment in perceived risky countries or reducing investment. I think that there are two key points here. One is that in many cases that's a deliberate strategy. It fits with the firm's approach for some form of global retrenchment, or they simply don't have the balance sheet appetite to take the risk anymore. But the other thing that we've found, and this plays out in the academic literature as well, and we had an additional question in this survey, is companies, the way they're valuing political risk, a very common approach to doing this is looking at the spread between US Treasury and the local country that you're in. We find that leads to an overstatement of political risk of about 30%. So in other words, to continue investing into a country, you have to meet a bigger threshold. So it feeds into this idea that a country is risky. We think this is it's a crude approach to risk management, partly because you have to remember that a lot of big global companies, their future growth is premised on the idea of exposure to higher risk, yes, but generally higher growth markets. The other thing that I think is interesting is the relative lack of companies that use political risk insurance.
Right, that sounds like it would be pretty straightforward for companies to do that.
You would think so, and there seem to be a number of reasons why it's not used, and particularly keep in mind that even though 41% of companies above $1 billion are saying they use it, that tends to be for isolated geographies. They're not global. They're not global policies. But I think there are a number of reasons for this. Political risk has generally been seen as random and infrequent. Therefore, why do the cost? Would you prefer to use the money on other things? And also, in general, my industry has not been exposed to political risk, so why should I take out the insurance? The other thing that we see both from last year's survey and this year's survey is that investor pressure or investor questions around corporate exposure to political risk is growing. So we would expect political risk to trend up over time because it's an easy win. Just a last point on this is what is missing from this list, which is essentially the introduction of risk managers at a much higher level. The use of scenario planning, the way political risk is communicated internally, I think is a huge issue. It's typically very qualitative, which is why with the likes of you economists, we've probably struggled to engage. So it's coming up with better ways to quantify political risk.
Right. Harry, what's your experience with how companies mitigate these risks? And I'd so like you to respond to the specific issue that Simon was making about we apparently don't really have very good metrics that companies can work with in order to begin to measure how exposed they really are.
Well, I guess two responses. One, at least the surveys that I've done at the firm level, both in China and Russia, throughout the former Soviet Union and Africa, rather than asking about perceptions of political risk, the questions were, and also buttressed by face-to-face business case studies, how many times did the tax inspector come to your plant this year? How many times did the regulatory authority on electricity raise their prices? And so we have more sort of fact-based data, which then in turn leads into the conversation of, okay, so what kinds of remedies might a company take in that regard? And frankly, some of the work that I did at PwC in my practice was helping companies devise strategies about becoming more agile, whether it's geographically or by getting multiple suppliers or multiple purchases, and B, actually doing economic impact assessments of the value of country I's investment in a country in terms of number of jobs, socioeconomic impacts, and so forth, that then gives them the opportunity to have the dialogue with the finance minister, with the economy minister, to say, listen, if you continue this, you're, killing the goose that's laying the golden eggs. And those have proven to be extraordinarily effective strategies to help mitigate some of these risks in a very operational way, at least in emerging markets.
Very good. So we're approaching, so we have another 10 minutes left. I'd like to ask Brian and Ilaria to bring up any issues that I've heard in the conversation so far that I'd like to put to the audience or to Simon and Harry to respond to. I'd like to encourage the audience, this is your last chance to put in any more questions that you may have, and then we're going to wrap up. So Brian, let me start with you. Listening to this conversation, what thoughts come up? What kind of issues would you still want to bring to us?
I want to return to Simon's point on communication, because I think communication internally is one issue to consider, but also communication externally is another issue. And as political polarization rises, it's not simply a matter of firms being able to operate across markets, but determining how that polarization is playing within markets and how to strategize about whether to stay above a local political fray or to maybe use political discord as an opportunity for branding. And we're seeing examples of both playing out in the US, and I would extend that to say that that's going to be a trend that you're going to see on a global basis. So I think this question of communication, this risk, not just of actual events happening like a physical expropriation of property, but simply reputational risk when interacting with unsavory governments, thinking about how your company's reputation in a local political context is evolving. That's going to become more and more important from a planning perspective, especially as social media just amplifies the importance of different political differences in people's daily lives.
Simon.
I think that's it's a key point, and it's also, if you look at the way companies are managing externally, you can see some really interesting examples in Nike, for example, is the way it's decided that through engaging in this discourse of economic and social fragmentation, it can win. So the example of Kaepernick, I'm probably going to say his name wrong, but essentially you watch that advert and it makes very subtle references to things like immigration, disability, equal rights, etc., and they've clearly decided that this is an area that will embed them with a particular segment of the market. The other part was probably not buying them anyway, so they've decided an approach, and essentially I think you'll see firms increasingly making clear their view on social and political issues.
Right, and the mention of social media is especially important here because, while it's on the one hand a huge risk because it can suddenly put your company in a really difficult place, you can also use it to your advantage. I mean, Harry, do you have good examples of companies who really communicated well around dealing with political risk and created a good way out or even a win?
Yeah, and this is why I mentioned these economic impact assessments, and particularly if they're done by third parties, not by the company in question, that show what the value of the company's investments are in the jurisdiction, in the city or in the country, that they can then take to the policymakers and say, listen, apart from violence and other kinds of things which are very difficult to control, but in terms of regulatory risk and economic policy risk, particularly those that might be directed at that particular company, that becomes a very effective tool, because you then have narratives to tell. And ultimately, governments, having served in this country, find very compelling ammunition is when they have narratives that guide them to make better decisions. But without the intellectual backing that comes from such kinds of assessment in terms of numbers of jobs created, environmental cleanliness, and so forth, those become very powerful communication tools.
Ilaria, any thoughts from your side on the conversation you've heard so far? Any questions you want to put to Simon and Harry?
Well, I like a lot of discussion on communication, but there was another couple of things I wanted to mention very, very briefly. One was that I wanted to mention scenarios because indeed I didn't see them on the chart here on how companies respond to political risk, and then Simon mentioned it, but I still wanted to add a couple of things because what I've seen is that every company makes scenarios, and some of them are, let's say, more like a very in-depth work. So you have the whole range. You have companies that circulate questionnaires to the C-suite, and then they synthesize the result, and it's like a 6-month process in order to really understand what are the risks and how they can handle them. And then you have more simple exercises. And then I heard one case which I have to say I liked a lot. It was really on political risk, where there is a sort of anonymous inbox in this company where people can throw ideas of what they think is a risk, and then somebody, the risk management team, checks this inbox, and it has been proven to be extremely useful because there are things that nobody would think about and that pop up in this mailbox anonymously. So I thought it was an interesting way of trying to anticipate unpredictable events. Another thing I wanted to mention on how to reduce political risk is about like self-discipline, and it's an interesting insight from a book called Cassandra's that we read with other colleagues. And what the authors mention is that we all live in bubbles, and with the current technology, we live even in bigger bubbles. So our assessment, we're all very much influenced by biases, and one way that we should really all make an effort there to try to deal with these biases is to give more space and time to people we don't agree with, or that don't share the same views, or have very different ideas. And I think it's a simple rule, but if we would all respect that rule, we would make our judgments in a more balanced way. And I really wanted to mention this because I thought it was useful.
That's a very good point. And actually, your second point is leading actually into the last thing we're going to do. We're going to open up our own mailbox. With people online, you can actually put in the one thing that you think is the biggest political risk that we may be missing. It's the kind of wild card. But I'm also going to ask each of the panel members to sort of throw in their wild card for 2019, the thing that you might not think about but could potentially be a risk. And that's what we're going to end with. So Brian, let me start with you.
Okay, balkanization of data markets. We're already seeing GDPR playing out in Europe. That's creating a greatest common denominator effect where many US companies have to adopt European data privacy and regulatory standards in order to comply. And certainly as the trade conflict with China escalates, you're going to have more difficulty in terms of companies that rely on using data as part of business models being able to operate the same way in the US and China.
Great. Simon, your wild card.
I'll add two if that's all right. My chances will increase. So I would keep an eye on the coalition government in Germany, and also my other wild card would be a potential collapse or major governance issue in Iran.
Okay, very good. Add it to the list. Ilaria, your wild card.
My wild card is technological, but with massive political implications, and that would be a breakthrough in batteries technology that makes the price of fossil fuels zero.
Oh, interesting. That will be a big one if it happens in 2019. Henry, your wild card.
Well, I'm going to also give an upside wild card. And you asked for wild cards, I'm going wild. A reunification of the Korean Peninsula.
Wow, that's another one.
Whether it's I've argued, for the U.S. when they renegotiate the Korea-U.S. free trade agreement that include North Korea.
Wow, that's a lot of food for thought and really good stuff. So we're at the top of the hour, almost at least very close. So first of all, Harry Brodman, thank you very much for joining us and to add into this conversation. Simon Coates from Oxford Analytica, thank you for joining us. Again, the report is downloadable from the Oxford Analytical website, so people can find more detail there. You can also go to the Conference Board website and see a review of this webcast and the podcast later on. Brian and Ilaria, thank you again for joining us and throwing these topics at you, and you guys still able to provide really good feedback on all this. So that's great. Next month, we're going to have our last window on for the year 2018. We take a pause in late December, of course, because of the holidays. We're going to go back to China next month. We already sort of picked that up a little bit here. That is, the question about how much China's growth performance is impacted by the trade disputes. As I said earlier, there is a bit of a misunderstanding here that, this downside effect on China's growth performance will change the story here, which may be true or may not be true. So we have our China Center experts joining us for that. And then finally, there are other sources at the conference board. I'd like to refer you actually to the US-China trade exposure piece that we just put out, and some other webcasts that we are going to deal with and that we're going to broadcast very soon. Thank you again for joining us. Don't forget the evaluation. Look out for the on-demand version as well as the podcast. And we hope to see you again on Window On in November, and that's going to be on November 28th. Thank you, and a good afternoon by now from New York.